Hello, I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have a great show for you this morning. Make sure you do send your questions to Brian Rezny at ReznyWealth.com, and also visit our website, ReznyWealth.com. Check out any of our free reports, instant downloads, whether it's about why annuities are dangerous to your wealth, your 3 biggest risks report. Check them out, valuable information. They're all free, instant download. You'll be glad you did. You know, Rezny Wealth Management is a fee-only fiduciary money management firm located right here in Southwest Florida. Offices, Fort Myers, Naples, and of course we have offices on the other side of the east side of the state as well. But if you have questions about your portfolio, you're concerned about the advice you're getting, please send those questions now to Brian Rezny at ReznyWealth.com. We have a great show for you today. I want to really discuss some of the big problem issues that we often find. The worst enemy when it comes to building your wealth is often really no advice at all. So let's talk a little bit about that today. Investors often invest in various investment assets. Maybe they don't have a strategy, maybe they do, maybe they think they do. A lot of investors ask me all the time, Brian, you've managed money for a long time. How do you manage risk in a portfolio? We'll talk about that a little bit in addition. But your worst enemy when it comes to building your wealth overall? Emotions and greed. Let's talk about both. Emotions. Things get a little rocky out there. You decide, hey, I'm going to sell. Or emotions. One asset did better last year than the other one. So you sell the one that didn't perform as well and overload the boat on another. That's an emotional decision. Greed. Of course, it happens to a lot of investors. Greed, simple. Somebody calls up and tells you, hey, I've got this no-risk investment. You get 8% on it. There are no-risk investments making 8%. Or somebody tells you about a penny stock or a non-traded REIT. Bottom line, emotions and greed often will have you make various investment decisions, and those investment decisions may not be the best for your financial security or building your wealth. It actually might torpedo your wealth down to the bottom. Lack of any investment strategy. I've been managing money for 30 years. We're a fee-only fiduciary money management firm. I will tell you, we've had numerous clients that have hired my firm over the years that are working with Wall Street firms, banks, or maybe they were sold an annuity. Some people come that were do-it-yourself investors. And I always ask these individuals, do you have a copy of your investment strategy? And very few people ever pull out an investment strategy. You want to know why? Because they really don't have an investment strategy. If you're with a bank, Wall Street firm, insurance company, and you're under suitability in a brokerage account, there's no investment strategy. You are actually managing your own money, so you have to develop your own. If you're managing your own money, period, a do-it-yourself investor, as we call it, through a discount firm, again, do you have an investment strategy and do you follow it? What is your research? How do you decide your buy and sell criteria? These are all important points. What happens if you don't have a strategy? It often means lesser return for your portfolio and often a lot less, which I'll discuss coming up. Don't chase what's hot after a big run-up. This happens every single year. Again, I've been managing money for a long time. Typically, what a lot of investors want to do, if they had 3 investments in their portfolio and 2 investments did really well and one didn't do so well, they want to sell the one that didn't do so well and put more money in the other 2. It happens all the time. There is a company called Delbar. They've done a study for 3 decades, 30 years, about investment returns and investor returns. Often, your returns are less than half of what the market was or the bond market. Why? Because of emotional decision-making and greed. These 2 factors lead to horrifically bad investment decisions and often losses in a portfolio. There is no free lunch when it comes to risk. I will often have somebody that will call my TV show or my radio shows, come into the office, and they will say, Brian, there was this guy that had a free steak dinner seminar, and he told me about this annuity that has no risk and I can get 8% returns. And I tell him, that's a lie. That person is blatantly lying to you. There are no 8% returns on your actual money you could pull out tomorrow. There's fake money, but that's not on your real money. But I hear this all the time. People think they can make a lot of money with no risk. If you want to make more than 1 or 2%, basically what current CD rates they are paying, you have to take some degree of risk. There is no free lunch. So if you want an opportunity to make a higher return, you've got to take some educated risk in a portfolio. Most investors invest too conservatively, but they get risky after a run-up. Hey, we've had a couple good years in the stock market. You know what happens with a lot of investors? Let's put more in stocks. But let's put more in stocks that went up the most. Just like in 2000, when investors lost 80 or 90% of the value of a lot of their stock holdings. Again, lack of investment strategy, but really emotions and greed are driving your decisions. That is a bad mixture. Reversion to the mean. What does that mean? Great example. So let's take a look at the year 2017. Technology stocks are up almost double what the S&P is up, almost double the return. You know what's going to happen as we go into the next year? Investors will sell what didn't do as well and plow more money into technology stocks that, in my opinion, are getting grossly overvalued. Or you've got new money to invest. You're going to look at the landscape, what did the best last year? Oh, technology. Let's put all of our money into that. You say you won't, but I've seen it happen. 30 years managing money, I've seen a lot of investors destruct their portfolio, and I've seen a lot of brokers do even worse than that. Greed and fear are a bad combination. Have an investment strategy. Reversion to the mean means if an asset category greatly outperforms another, like technology this year, that probably means technology might lag or go down next year. So you might be better off going onto the value side, adding money to areas that didn't do quite as well, but still have a catalyst to grow. Reduce bond investments. I've talked about this in the last couple years. Rates are very low and they're starting to slowly move up. The Fed has stated we're going to probably raise rates again in 2018 as long as the economy stays stable. As rates move up, bond values go down. If I look at 2017, a lot of bond investments made a third or less the return that the equity markets made. I'm not saying you should get rid of all your bonds. I'm saying you should reduce your bond exposure and or the duration or the type of bonds in your portfolio. Most investors won't do that. In fact, if I look at money flow, where money has gone this year, a lot of investors keep plowing money into bonds, not understanding that they could be very, very risky when rates go up. Hire a real advisory firm to manage your wealth. If you are unable to manage your own money, maybe you're doing it yourself and you realize that I'm not really doing that great of a job. Hire a real money manager, a fee-only fiduciary money management firm. If you're with a Wall Street firm or bank and you're realizing they're not legally working for me under suitability and they're not really doing a great job, they don't have an investment strategy and they don't have a way to manage the risk or they don't have a risk management strategy, maybe you should get a second opinion. What I would suggest is call Rezny Wealth Management. We're local, Southwest Florida, right here in Fort Myers and in Naples. Call us, schedule a consultation. The only kind of firm you should ever entrust your hard-earned life savings is a fee-only fiduciary money management firm. And I've talked about this a lot. We try to educate you. Make sure you get real advice, not the sales job. Go to ReznyWealth.com, visit our website, sign up for a consultation. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your so-called advisor really just an annuity salesman? Fact. Annuities are sold by misleading you, the investor. Sky-high expenses, crazy surrender penalties, and mediocre investments rob your returns and rob your security. My advice, stop being sold. If you want real money management, real advice, call my firm today. And we're back. I hope you're enjoying today's program. And of course, if you have questions about your portfolio or an investment, send them to Brian Rezny at ReznyWealth.com. Hey, make sure you do visit our website, ReznyWealth.com, and make sure you listen to my live radio show on Sunday mornings. Go to ReznyWealth.com for times and availabilities. A lot of great information on that show in addition to my TV show. We really enjoy educating investors. And of course, if you're looking for portfolio management, please call our office. We'd love to help you build your portfolio in a manner that's conducive for your risk profile, your goals and objectives, and in your legal best interest as a fee-only fiduciary money management firm. Check us out at ReznyWealth.com. You'll be glad you did. Marissa from Madison, Wisconsin. Financials and banks as an investment, your thoughts. Marissa, excellent question. I like the category. If you are going to invest in financials or banks, what I would say to you is look at an ETF, an exchange-traded fund, so you stay diversified. So instead of just buying 5 or 10 stocks of banks, buy an ETF or look at an ETF. One you can research yourself is the XLF. And that basically owns a broad basket in a nice ETF wrapper of financial stocks, bank stocks, and brokered stocks. That, to me, is going to be a growth opportunity category. Generally speaking, it's more value-oriented, underpriced in the market. If rates slowly move up in 2018, which I firmly believe they will if the economy stays on this kind of path, financials, banks do better when rates are a little bit higher. So that's one of the reasons in 2017 you saw banks actually do quite well because rates obviously, the rates went up this year a couple times. And I expect something similar if the economy stays on this path as we go into next year. Often, areas that investors want to invest are areas that were hottest the year before. While financials have done well, they didn't do near as well as other areas of the market, and because of their low valuation, I think it's a great opportunity for a part of a portfolio. Terry from Fort Myers, Florida. My advisor wants me to switch my variable annuity to an equity index annuity. He says it's better. Your thoughts? Terry, you are being bamboozled and sold by a so-called fake advisor. First off, anybody who sells annuities for commission is not an advisor. They're a salesman of annuities. Number two, they don't legally work for you. He's selling you a product under suitability. He only is selling you what's best for his pocketbook, not for yours. Number three, you're going to basically get out of a variable annuity, get back into a new surrender penalty into an equity index annuity. Personally, while I do not like variable annuities, there's better options for your money. A variable annuity, in my opinion, is a better opportunity than an equity index annuity. This annuity person trying to sell you the upgraded version, who's blatantly lying to you, is only looking at the commissions it'll generate for him versus what's good for your portfolio. What I would suggest you do, call my firm, schedule a second opinion consultation. Let's look at that variable annuity. We can actually tell you what your internal cost ratio is, how well the investments are or good, and then maybe we can show you a better plan of attack opportunity for your money that's legally better for you under a fiduciary standard. Check us out at ReznyWealth.com. Schedule a consultation. We'd love to give you a second opinion consultation and help get you back on track. Joe from Naples, Florida. What do you think of DAX as a way to invest in Germany? Folks, DAX is actually an ETF, exchange-traded fund. The symbol is DAX. It invests in Germany. It owns German stocks. Actually, Joe, general question, what I would say to you is this. I like Germany. It's definitely one of the big leaders in financial stability in Europe. But Europe overall, developed Europe, is really coming back a little bit. They've had many, many years of recessions or basically no growth. I think there's opportunity in developed Europe overall. I do like Germany, and I do like the fact that you're looking at an ETF and being a little more diversified. I think that it has opportunity, and I like the question, and I like the opportunity in DAX. Terry from New Orleans. Last year was a really good year for my stock, for the stock market, but my 401k plan didn't perform nearly as well. My portfolio is invested 60% mix in growth and value mutual funds and about 30% in bond funds, with the rest in an international mutual fund. The S&P was up almost 10, but I was only up 4.5. What gives? Terry, probably what happened is the funds that you invested in either are not good performing funds, or the other part of the equation is you did have a pretty big chunk, 30%, in bond funds. You got to remember, bond funds, the chance of bond funds doing as well as an equity fund, mutual fund, in an up market is slim to none. So what I would say to you is this: what is your age? If you've got 3 to 5 years minimum before retirement, and you're not going to spend all your money the day you retire, you may want to take a look at changing that allocation more to an equity allocation if you're looking for higher growth. The problem is, again, too much bonds, and a lot of people face that, by the way. I see this all the time. The vast majority of people that come into our firm are over-concentrated in bonds and not, in my opinion, better opportunity areas that can grow as the economy does a little better under our GDP, our new tax structure, and our new president. John from Fort Myers, Florida. Is risk on for the U.S. economy? Will we continue to grow, and should I invest in the stock market? Risk on, folks, basically means put money to work in assets that have risk, that have an opportunity to go up. John, generally speaking, what we're seeing right now for 2018 is growth. We like what we're seeing. That doesn't mean that we're not going to get some hiccups. And I expect, as I do every year, some kind of pullback in the equity market, some kind of short-term correction. We're not seeing recessions currently or any sign of that, but that may change in 9 months. Generally speaking, I expect the U.S. economy to grow. I like the equity markets. Some of the areas in the U.S. are good, but I also prefer some areas in emerging markets and developed Europe, as I talked earlier. I think too many investors only invest in the U.S. because they don't look outside the box. There's better opportunities with cheaper valuations and potentially higher growth rates on earnings overseas versus the U.S. One of the areas, in my opinion, that is well overbought, well overvalued, is really in the large cap technology sector, because everybody's been jumping on that bandwagon, and the outperformance of that typically is not going to last. So I would be avoiding areas like that are grossly overvalued and look for cheaper areas of the overall economy, I think, as a better opportunity for your money. Jen from Cape Coral, Florida. Is Europe a good investment for investors, and what would you buy? Jen, as I've talked in the last couple of questions, I do like developed Europe. You might want to look at something like the Vanguard VGK. That's an ETF. It owns a diverse portfolio of European stocks. Again, diversification is key. Most investors in general, Jen, will not be able to build a stock portfolio of European stocks. You're probably not going to have the time, the talent, the energy, or the resources to do the kind of research you need to do on individual stocks. Let me kind of go a step further with this. We often find investors, when they come to our firm and hire us, a lot of times will have individual stocks in their portfolio. And I'm not against individual stocks. What I will tell you, though, is owning a portfolio of 30, 40, 50 individual stocks will have a lot more volatility than, let's say, the S&P 500. And often I've seen making a lot less money. So you have a lot more volatility owning individual stocks, and you make less money than investing in a broad index, let's say the S&P 500. Stocks are not the only game in town, and stocks are more volatile than ETFs, generally speaking. I think investors should really look at the opportunities. ETFs, in my opinion, exchange-traded funds, give investors a great opportunity to diversify at a low-cost structure, and in my opinion, are far superior than stocks and mutual funds for individual money-managed accounts. We use a lot of ETFs at Rezny Wealth Management, and I feel, in my opinion, that they are the best tool in the toolbox to diversify a portfolio properly, and they're really giving an investor the opportunity they're looking for, which is return on their money. I'm going to take a quick break. Go to ReznyWealth.com and visit our website. Check out any of our information, our free reports. Sign up for a consultation. Remember, we're right here in Southwest Florida. Offices right here in Fort Myers and in Naples. If you're concerned about the advice you're receiving, if you're looking for that second opinion, call my firm. Our number's on the bottom of the screen. I'll be right back after this short break. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your broker working in your best interests, or are you being sold inferior investments by Wall Street firms and annuity salespeople? My advice, never settle for bad advice if you value your financial and retirement security. Real money management, real advice is the difference my firm provides. Call us today and schedule a consultation. And we're back. I hope you're enjoying today's program. Of course, if you have questions about your portfolio, send them to Brian Rezny at ReznyWealth.com. And as I always suggest, second opinions are always beneficial at my firm. Call us. Schedule a consultation. Let's take a look at your portfolio. If you're looking for real money management and real advice from a fee-only fiduciary money management firm, call us. Schedule a consultation. I know a lot of you out there are busy. Sometimes procrastination comes into play. You've heard me say that before. You remember, you always have time to review your portfolio. If you care about your net worth, your financial security, if you want to make sure you're getting real advice, give us a call. Schedule a consultation. We're right here in Fort Myers and in Naples. I'd love to see you personally. Call my staff. Let's schedule a consultation. Rob from Miami, Florida. Which investment sectors are moving up and which ones are moving down? You mentioned healthcare earlier this year. Rob, generally speaking, we still own healthcare. That may change at any time. I will say that. I like healthcare, and I may continue to own that for some length of time. One of the things that I always look at is if you look at individual sectors, whether it's oil, whether it's healthcare, whether it's financials, technology, whatever the sector may be, is what's the ability of that sector? A, first, valuation, is it reasonable or cheap? And number two, is there an opportunity, a catalyst to make that asset go up in value? If there's not a catalyst, meaning earnings growth isn't going to be there, there's a likelihood that investment will not perform the way you want it to. Healthcare, valuation looks good, future growth looks good, earnings opportunity looks good. I'd say as a sector, I would take a look at that. We talked about financials at some point. That might be another particular sector. Remember, sectors change over time. You may own a sector for a year, 2 or 3. You may own it for 3 months. You need to do your homework and you need to stay on top of things. If you're unable to do that, that's why you would hire a real money management firm like Rezny Wealth Management, because we do look at all sectors, all investments, and encompass what we feel is appropriate and opportunity for our client's portfolio. Tom from Miami, Florida. What's your top sector pick right now? What signals do you look for to decide when it's time to jump in or out of a sector? Tom, similar question to my last one. The big thing is, again, earnings. If you look at any investment sector or any investment opportunity, earnings drive valuation either down or up. If earnings are flat or sinking, chances are that asset or sector will be going down. If earnings are going up or expected to go up, there's a better likelihood, the opportunity that that asset may go up in value. So if I look at sectors, I mentioned a few earlier, but I'll give you this. Really take a look at Europe and take a look at emerging markets, folks. I find when we review portfolios from other firms, people come in to hire us because they're unhappy either with the return they're getting, with the advice they're getting, they realize they're not getting advice at all. When they come to us, I would estimate our typical new client coming in has less than a 5% exposure, if that, between emerging markets and developed Europe. Maybe 5% combination. Sometimes it's 1, sometimes it's 2, sometimes it's none. So is your advisor really looking at all the opportunities, or are you just sitting in the U.S. where maybe you're basically giving up some opportunity and maybe some return in your portfolio? Tim from Fort Myers, Florida. Are investors facing a decade of flat to negative bond market returns? Tim, what I would say about the bond market is this. If you remember Jimmy Carter days, rates were up here, and as rates slowly have come down the last 3 or 4 decades, bonds have done quite well. I think a lot of investors do not understand how bonds work, so they're buying bonds because either they think they're safe or don't understand how interest rates affect bonds. I think bonds over the next decade will be below average rates of return and probably one of the worst return areas an investor can be in. And again, it depends what kind of bonds. Long-term bonds, short-term bonds, government bonds, corporate. There's all kinds of different bonds. But bonds in general, I think are going to be lower return and higher volatility and higher risk than I think a lot of investors realize or will expect. Sandy from Fort Myers, Florida. Our advisor only recommends annuities, and I keep hearing bad things about annuities. What do you think? I think annuities stink. Annuities are sold by annuity salespeople who care about the biggest commission and not your net worth or making you money. Annuities are sold on false information often or blatant lies. I've seen that a lot. Investors are often told about no risk or 8% returns or free money bonuses. These, again, are all lies. You, as the investor, need to read the fine print. Somebody who's selling an annuity cares less about you and only about the commission. There are better investments and better ways to invest your money, even if you want to be more conservative, in our opinion, than an annuity. You are going to give up a small chunk of your net worth and return by investing in an annuity. The expenses are sky high on annuities. The surrender penalties are long and harsh to get all your money out. And when you pull the money out, you're going to pay higher taxes than you were led to believe by the annuity salesperson, or as we call these people, annuity charlatans. Read the facts. Don't rely on a salesperson. If you're not feeling well, you don't go to a salesperson, you go to your doctor. If you want real money management, only hire a fee-only fiduciary money manager. If you want real advice, that's what I would suggest. Also, go to my website, reznywealth.com, and download for free Why Annuities Are Dangerous to Your Wealth and Retirement. It's a free report. It'll open your eyes about annuities and really what goes on and how they hurt your retirement. Results, retirement security, and peace of mind. Experience the Rezny Wealth Management difference. My advice, never settle. Get a second opinion. Call us today. Schedule a consultation, 800-618-8577. Make sure you visit our website, reznywealth.com. Read any of our reports, instant downloads, sign up for any of our information. You can also enter your email address, by the way, and get instant updates about the economy, the market, and great investment articles that we feel will help you benefit. I'll see you guys next week.